Tax Cuts and Jobs Act. Ordinary income tax rates reduced across the board. Standard deduction of $12,000 single and $24,000 married filing jointly. The state and local tax deduction is capped at $10,000, and home interest deduction is capped at loan amount of $750,000. Long-term capital gains rates remain the same. Corporate tax rates cut by 40%. Estate tax exclusion doubled. The top rate is 40%. Mortgage interest deductions, home acquisition loans. All are part of the interest paid during the year for up to 2 homes. For debt incurred before December 15, 2017, interest can be deducted for up to $1 million in debt. For debt incurred after December 15, 2017, the limit is $750,000. Residence is any structure that provides basic living accommodation. Mortgage interest deductions, home equity loans. Interest is no longer deductible. Home construction loans, from the time of the construction for 24 months. Refinance loans, for the time of construction for 24 months. Points. 1 point equals 1% of the loan amount. Points are deductible in the year paid if it's a personal residence and that the points do not exceed the typical charges for the area. Points paid by the seller are deductible by the buyer as interest. Points paid to refinance must be capitalized, then amortized over the life of the loan. Vacation homes, properties rented for less than 15 days a year. The rental income not reported, and all normal deductions apply for owner up to the limits. Property rented for 15 days a year or more, and personal use days are less than 14. Same tax treatment as investment property. Property rented for 15 days a year or more, and more than 10% of the days rented, the expenses can be deducted to the extent of the income. An office in your home is only deductible if the area in the home is used exclusively for business. No other fixed location exists where taxpayers carried out administrative work. Usually, sales associates do not qualify. When selling a principal residence, if a taxpayer uses the home as a principal residence for 2 of the past 5 years, a single filer can exclude tax on up to $250,000 of gain on the sale. A married couple filing jointly can exclude tax on up to $500,000 on the gain of a sale. Tax treatment for investment property. To calculate taxable income, start with the net operating income. Add reserves for replacements, and subtract the interest, subtract the depreciation, subtract the amortization of loan cost, and that's going to equal the taxable income. Calculating depreciation, you're going to add all cost of acquisition, allocate between land and improvements, which one's which. Only improvements can be depreciated. You can use a percentage such as that's used by the property appraiser, and then you're going to divide the depreciable basis by the number of years. You have 2 here. 27.5 years is for residential property, and they mean property that people live in, not 4 or fewer units. Apartment complexes, whatever. The other one is 39 years, and that's for non-residential property, which would be office complex, strip centers, such as that. Investments of tax classifications. You have personal residence and then the for sale to customers. If it's your personal residence, interest and taxes are deductible, and taxes on gain on sales may be excluded. For sale to customers, you cannot deduct depreciation and you cannot use capital gains tax rates. Let's talk about the difference between passive and non-passive income. Passive income is rental income is automatically passive. Losses cannot be deducted from non-passive income. Active participants can deduct up to $25,000 of passive losses against non-passive income. What is non-passive income? Real estate professionals can deduct all operating losses from other income.